Welcome back to the deep dive. Today we're cracking open a really dense stack of sources.
A really wide range, too.
Exactly. We've got finance reports, regulatory docs, deep tech research, and consumer news.
All sort of pointing in the same direction.
Right, and all to show you how these major forces think artificial intelligence, shifting government priorities, are just colliding. It's creating incredible friction.
But also, some once-in-a-generation opportunities.
Our mission today is pretty simple. We're connecting three critical threads for you. We're tracking how the big market titans are changing their investment strategy.
Then we're looking at the high-stakes regulatory and ethical debates around AI.
And finally, we'll translate what these huge economic shifts mean for your own wallet, for your assets, and, for your financial action plan.
And we're going to start right at the top with a massive investment that really signaled a shift on Wall Street.
Okay, let's unpack this. Starting with a rare and pretty seismic signal from Warren Buffett's Berkshire Hathaway.
The headline is clear. Berkshire revealed a $4.3 billion stake in Alphabet, the parent company of Google.
Wow.
Yeah, as of the end of the last quarter. That investment immediately made it the conglomerate's 10th largest equity holding.
And for context, this is a huge move because Buffett has traditionally been, let's say, skeptical of pure technology stocks.
Right. He loved Apple, yes. But he always frames that as a highly sticky consumer product company.
This Alphabet investment, though, it looks much more like a direct bet on the future of AI and cloud computing.
It absolutely does.
Yeah.
And while the sheer size of the stake suggests Buffett's ultimate blessing, the investment itself is widely attributed to his two younger lieutenants, Todd Combs or Ted Weschler.
They're the ones who have been pushing Berkshire into areas like cloud and e-commerce.
Exactly. But what's so fascinating here is the history. It's come full circle.
How so?
Well, over 2 decades ago, Google founders Larry Page and Sergey Brin explicitly cited Buffett's famous An Owner's Manual essays as the inspiration for the philosophy they laid out in Google's original IPO prospectus.
So it's almost like a decades-long return on a philosophical investment.
It is. And if you look at the numbers, it makes perfect sense why they buy in now.
Okay, so talk me through that, because Alphabet shares have already surged, roughly 50% this year?
They have, yeah. Mostly on the back of AI progress and big growth in Google Cloud. But even with that run-up, it remains attractively valued compared to its competitors.
How exactly do we measure that value difference for listeners who might not track these specific metrics?
So we look at the price-to-earnings ratio, specifically forward PE, which is looking at next year's earnings.
Okay.
Alphabet is trading at about 26.9 times next year's earnings. Now, compare that to peers like Microsoft and NVIDIA. Both are sitting closer to 31.8 times.
So Berkshire is getting exposure to the AI boom, but at a significant discount based on what's expected next year.
Exactly. It's basically a value purchase inside a high-growth sector. They're buying the massive long-term AI potential without paying that top-tier premium.
But even 26.9, that's still quite high for a traditional value investor.
Oh, it is. And that signals something important. It shows that even the most cautious capital managers recognize AI is fundamentally changing the calculus of what value even means. The risk tolerance has shifted.
So the winners of this AI build-out, like Alphabet and NVIDIA, are making these huge moves, but their demand is creating immense pain and friction further down the supply chain.
Yes, specifically for the hardware makers.
Right.
This is where the supply chain squeeze gets really dramatic. We saw companies like Dell and HPE who make the physical servers and storage. Their stocks took a dip after some downgrades.
Why?
Analysts are warning they face an unprecedented pricing supercycle in memory components.
You mentioned hyperscalers in the source. Can we quickly define that?
Absolutely. Hyperscalers are the absolute giants of cloud infrastructure. So think Google, Amazon, and Microsoft.
Okay. The big three.
Their massive scale means their demand for new data centers is so immense that it's now just overriding the traditional tech supply and demand cycles.
And what are the specific components they're demanding so intensely that prices are spiking?
The main pressure points are DRAM and NAND memory. Think of these as the fundamental building blocks. DRAM is the fast working memory, and NAND is the storage, like in your SSD.
And AI needs a ton of both.
A ton. And we're seeing a major manufacturer like Samsung reportedly hiking memory chip prices by as much as 60% since just September.
60%. That has to just crush the hardware assemblers' bottom lines.
It absolutely does, because memory can account for anywhere from 10% to a staggering 70% of a hardware product's total bill of materials.
Wow.
So the key insight here is that the AI giants are now so powerful, their demand is breaking the normal cycles and squeezing the profitability of everyone below them.
And we saw that historically with Dell, didn't we?
Precisely. Dell was flagged as being highly exposed because under the last memory cycle a few years back, their gross margins contracted by 95 to 170 basis points.
Quick translation, a basis point is 1/100th of a percentage point. So 170 basis points is a 1.7% contraction in margin.
Right. And that might not sound huge, but when your business is high volume, low margin, computer assembly.
That can decimate your profit.
Exactly. If they can't pass those costs on, profitability shrinks fast.
Okay, now let's look at the company at the very center of this demand explosion. NVIDIA. Despite all the anxiety over stretched valuations, their numbers are, well, they're frankly astronomical.
CEO Jensen Huang recently revealed that NVIDIA has orders totaling a colossal $500 billion for its chips.
$500 billion.
$500 billion. And that's for its Blackwell and upcoming Rubin GPUs, plus networking components combined for 2025 and 2026.
That number just speaks volumes about the insatiable AI appetite, but is it reliable? I mean, what if the build-out slows down or new competitors finally show up?
That is the $500 billion question. Analysts are confident it signals meaningful upside, potentially adding $60 billion to the 2026 revenue estimate for the data center segment alone.
But that all depends on the hyperscalers continuing to spend.
It relies entirely on customers like Google, Amazon, Microsoft, and Meta continuing their massive capital expenditures at the current pace, or even faster. It assumes that AI supply below demand dynamic continues without a hitch.
And that insatiable demand brings us right into our second major area of friction: policy, regulation, and where tech money is being spent to shape the rules.
And this is where the politics of AI get really intense. There's a new bipartisan super PAC leading the future.
Okay.
It's backed by over $100 million from industry titans like Andreessen Horowitz, Palantir's co-founder Joe Lonsdale. And it has picked its first political target.
Who is it?
A state-level politician in New York, Assemblymember Alex Bors.
A state-level race. That seems odd for a national PAC with that kind of money behind it.
It does, but it's because Bors co-sponsored the RAISE Act. It's a state bill that would require the largest AI companies to publish specific safety protocols.
For what kind of things?
Things like misuse for, say, biological weapons. And it would force them to disclose serious incidents or face civil penalties if they don't.
And the industry is, I'm guessing, terrified of this.
Oh, yeah. The PAC leaders argue the RAISE Act is patchwork, uninformed, and bureaucratic. They say it threatens American progress and could let China win the AI race.
But the real strategic issue here isn't just one state bill, is it?
No, you're right. The core insight is that the tech industry is spending this money to prevent a patchwork of 50 different state-level regulations.
That makes sense.
If California, New York, and Texas all pass different laws, it becomes a logistical and legal nightmare. They're trying to preempt state action to force a single federal industry-friendly regulation instead.
Bors, though, he's not backing down.
Not at all. He has a master's in computer science, multiple patents, and he countered by saying the industry is, quote, scared of people who understand their business regulating their business.
It's a high-stakes battle, and the argument for regulation, it often gets louder when ethical lapses or security risks get exposed. We have a very serious example of that.
A very troubling one. We're talking about the arrest of Eric Gillespie, the founder of the defense contractor Govini, in a child sex sting.
The details are disturbing, but the implications for national security are really the critical takeaway here.
Absolutely. The stakes are immense. Govini is a critical technology player in the defense space. They just landed a nearly $1 billion Department of Defense contract.
And what happened to Gillespie?
Govini terminated him immediately. But Pentagon officials are now scrutinizing the entire matter for security issues. It's a profound illustration of the risk when individuals controlling critical defense infrastructure face that kind of personal and legal instability.
Shifting to administrative friction in the government itself, we saw some sudden instability at FEMA.
Yeah, the acting head, David Richardson, stepped down after just 6 months.
And it was a troubled tenure.
It was. Plagued by specific criticisms, like keeping a remarkably low profile during deadly Texas floods, and, incredibly, stating he was unaware the country even had a hurricane season.
He's the second FEMA head to leave or be fired since May, and this is all happening while the agency itself is shrinking.
It is. FEMA has lost about 2,500 employees since January. So you have instability in leadership plus reduced capacity. That's a recipe for system risk, when the next major disaster hits.
We also saw some significant legal turmoil that really gets to the integrity of the judicial process, this time involving former FBI Director James Comey.
Right. A federal magistrate judge suggested the indictment against Comey could be dismissed because of some profound issues with the grand jury process.
What were the specific issues? What did the judge say pointed to prosecutorial misconduct?
The judge cited two specific statements made by the interim U.S. attorney that, on their face, appear to be fundamental misstatements of the law.
And one was particularly bad.
One was critical. It incorrectly suggested that Comey did not have a Fifth Amendment right not to testify at his own trial.
That is a fundamental flaw in the legal process.
It is. The judge called it a fundamental and highly prejudicial misstatement of the law, which creates a direct path for the whole indictment to be dismissed for tainting the grand jury.
Okay, let's pivot from high-stakes legal and political fiction to the real economy and what's hitting the consumer wallet, starting with a big affordability win in healthcare.
A pretty significant one. Novo Nordisk, the maker of Wegovy and Ozempic, has cut its direct-to-consumer prices for existing cash-paying patients.
By how much?
The price is dropping from $499 a month down to $349 a month for most dosages.
So that's a roughly 30% reduction for people already on the drugs.
And there's an even bigger incentive for new patients, a temporary introductory deal. New cash-paying patients can get the two lowest doses for $199 a month for their first 2 months.
That's a clear response to all the pressure over affordability.
Absolutely. It follows some recent deals struck with the administration aimed at expanding access.
Now, let's look at a micromarket that seems completely decoupled from normal economic rules: luxury real estate.
Yeah, we have an unbelievable moment of appreciation involving Mark Wahlberg's recent purchase in Florida.
Okay, so what did he buy?
He just paid $37 million for a mansion called Palazzo di Lago in Delray Beach. But the price itself isn't the story. The appreciation is the story.
What was the appreciation?
That $37 million price represents a dramatic 118% increase since the house last sold in January 2020 for $17 million.
118% in less than 5 years. It dwarfs other top luxury markets, doesn't it?
It absolutely dwarfs them. Los Angeles was up about 30% in that same time frame. The Hamptons, up 44%.
So what is driving that specific surge in that one spot in Florida?
It's a perfect storm of factors. First, you had the initial pandemic surge to South Florida. Second, the incredible allure of VIP neighbors billionaire Steve Cohen lives next door. Third, Florida's tax advantages continue to draw that high net worth migration.
And the property itself was upgraded.
Oh, yeah. It had a multi-million-dollar James Bond-inspired renovation. And you see this concentrated demand in the land prices. Vacant lot prices in that exclusive community have gone up threefold since 2013.
When supply is that crunched, appreciation just becomes exponential.
Exactly.
That level of appreciation puts even the strongest stock market returns into perspective. But let's bring this back to your immediate finances. If you just got a raise, what's the expert advice?
The most important thing is fighting lifestyle creep.
That tendency to just increase your spending to match your new income.
Exactly. So financial planners really emphasize a three-step plan.
And step one should be very concrete.
It is. Step one, calculate your actual net take-home pay. A raise might push you into a new tax bracket, so you need to know exactly how much new money is hitting your bank account after all deductions.
Don't budget based on the gross number.
Never. Then step two, build a strategic budget around that new net income. Resist the urge to automatically increase spending everywhere. Decide what actually improves your quality of life and allocate the new funds there.
And finally, step three, prioritize long-term security.
Right. Accelerate your retirement savings. The standard recommendation is to aim for at least 15% of your annual income going to retirement, including any employer match, and then maybe supplement that with a Roth IRA.
Before we wrap up, let's just check in on the automotive sector. It's seeing some pretty necessary pivots right now.
We're seeing a major turnaround attempt at Jeep. They've had 6 consecutive years of U.S. sales declines.
And that was largely blamed on a failed premium pricing strategy, right?
Yeah, their average transaction prices were around $54,000 in recent years, which is well above the industry average. People just weren't paying it.
So the pivot is away from premium pricing and more toward volume.
Yes. They're realigning their pricing and launching a big product blitz, including the all-electric Recon SUV this week.
And distribution models are changing too, fundamentally.
They are. Ford just announced a partnership with Amazon to let their dealers sell certified pre-owned or CPO vehicles directly online.
So you can handle financing and schedule a pickup right on Amazon.
right on the platform. It follows a similar deal Hyundai made with Amazon for new cars. Digital distribution is now just essential.
We've covered a tremendous amount of ground today. We've tracked capital chasing AI growth, how that growth causes these bottlenecks, and how the political battles are raging over the technology's future.
And if we synthesize the major themes, the defining friction in the economy right now is centered on AI. We see massive profit potential, Berkshire buying Alphabet, NVIDIA's $500 billion forecast.
But also significant real costs.
Right. Hardware makers getting squeezed on component pricing, and the industry fighting tooth and nail to avoid regulatory oversight.
What's truly remarkable is just the speed of it all. We've seen tech money trying to influence state policy directly, and we heard a top economic aide suggest that AI-driven productivity is already causing a measurable quiet time in hiring.
That implies the labor market is structurally changing right now.
And that structural shift is the critical takeaway. It means the economic gains from AI aren't just hypothetical. They're already visible in reduced labor needs.
So we'll leave you with this provocative thought to explore on your own. If technology, through AI-driven productivity, is already creating softness in the labor market by reducing the need to hire,
While at the same time driving up the cost of the chips and hardware needed to build that very infrastructure.
where exactly does the economic benefit flow? And what steps should you be taking right now to navigate a labor market that is increasingly being defined by these AI productivity gains?